Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of the ultimate guide to divestitures, strategies, benefits, and real-world insights. Understanding the buyer's perspective. What's valuable to you might not be valuable to a buyer. Tailor the pitch to highlight aspects like revenue streams, scalability, or synergies. Flexible pricing. While you should aim for maximum value, leaving room for negotiation is smart. Rigid pricing could discourage potential buyers. Treat pricing like setting a price for a car. If you price too high, you'll scare buyers off. Too low? You leave money on the table. A balance is key. Legal and regulatory considerations. Divestitures aren't just business transactions, they're legal ones too. Navigating the legal landscape can feel like walking through a minefield. One misstep could lead to significant complications. Here's what to consider on the legal and regulatory front. Compliance requirements. Ensure the divestiture complies with all local, state, and federal laws. Industries like healthcare or finance may face stricter regulations. Antitrust concerns. If the deal could reduce market competition, it may attract scrutiny from antitrust authorities. Be prepared to address these issues upfront. Contractual obligations. Existing contracts tied to the asset, such as vendor agreements or lease terms, need to be reviewed and potentially reassigned or terminated. Intellectual property, IP. If intellectual property is part of the deal, ensure proper transfer of ownership or licensing. Given the complexity, consulting with legal experts can help you avoid costly mistakes. Treat legal considerations as your safety net. Without it, the entire divestiture could fall apart. Challenges and risks of divestitures. Divestitures can be a powerful strategy for companies to refine their focus and improve financial performance. However, they aren't without challenges. The process is complex and can create risks that, if not managed carefully, may harm the business. Below, we'll dig into some of the most common difficulties organizations face during a divestiture. Operational disruptions. Divestitures often create operational hiccups, no matter how well planned they are. Separating a business unit, reallocating resources, and shifting priorities can throw normal operations off course. Disrupted supply chains. If the divested unit relies on shared suppliers or logistics, restructuring these relationships takes time and effort. Delays or inefficiencies can emerge during the transition. System integration issues. Many businesses rely on interconnected IT systems for operations. Splitting these systems during a divestiture can cause technical glitches or downtime. Customer service challenges. Customers may notice changes in product availability, communication, or response times, potentially damaging trust. Even if these disruptions are temporary, they can hurt the bottom line and leave lasting effects if not addressed quickly. Think of it like renovating a house while living in it. There will be some mess before everything gets sorted out. Impact on employee morale. Divestitures impact employees just as much as the company itself. When teams face uncertainty about their roles, it can lead to stress, confusion, and disengagement. Fear of job loss. Employees in the divested unit or surrounding teams may worry about layoffs. Even those unaffected directly can feel the ripple effects. Loss of connection. Transferring employees to a new company or separating teams can change long-standing workplace dynamics. Losing familiar coworkers or leaders often affects morale. Cultural shift. If the divested unit joins another organization, adapting to a new culture may create friction and frustration. Employees are the backbone of any business. If their trust and morale take a hit, it can slow productivity and create lingering dissatisfaction. Communicating openly and offering support through the transition can help. Market reaction and reputation risks. How the market and stakeholders react to a divestiture can make or break its success. Missteps during the process may shake confidence in a company's ability to execute effectively. Stock price volatility. Announcing a divestiture can cause stock prices to move, sometimes unpredictably. Investors need clear communication to understand the value behind the decision. Public perception. Customers and vendors might interpret the move as a sign of instability, even if it's strategic. This can harm the brand's reputation unless the message is framed positively. Competitor advantage. Divestitures can create gaps in the company's product or service offerings, opening doors for competitors to take market share. Managing external perceptions is critical. A well-executed communication strategy ensures stakeholders see the divestiture as a proactive step rather than a sign of trouble. Each of these risks is manageable with forethought and planning, but they serve as a reminder that divestitures are not without complexity. Every action in the process has consequences that ripple across employees, operations, and the market. Case studies of successful divestitures. Divestitures, when done right, can reshape businesses for the better. Real-world examples show how companies have used them strategically to thrive. These cases highlight the importance of timing, execution, and clear objectives in achieving success. Let's take a closer look. Case study. Company A. In 2019, PepsiCo pulled off a strategic divestiture by selling its Tropicana and other juice brands to a private equity firm for $3.3 billion. Why did a global beverage powerhouse step back from a highly recognized brand? The answer lies in prioritization and long-term focus. PepsiCo wanted to shift its attention to higher growth products like snacks and healthier beverage alternatives. Juice sales were slowing, and the category's high sugar content didn't align with changing consumer trends. Instead of stretching resources across multiple fronts, PepsiCo chose to double down on areas with better growth potential. What made this divestiture successful? Clear objectives. PepsiCo understood it wanted to focus on core areas like snacks and non-sugar beverages. Market timing. Juice had a steady but declining demand, making it a good time to sell while still fetching a strong price. Efficient execution. The sale streamlined operations, allowing management to reallocate their efforts to emerging priority sectors. This move reinforced PepsiCo's ability to stay agile in a changing market. By cutting what wasn't working as well, it freed up resources for more promising opportunities. Case study. Company B. In 2015, GE, General Electric, made headlines by selling its GE Capital division, which it had owned for decades. At the time, GE Capital accounted for a significant portion of the company's revenue, so why give it up? The decision stemmed from risk management and a desire to refocus on industrial innovation. After the 2008 financial crisis, regulatory burdens on financial businesses tightened. GE Capital's banking-like activities posed risks that no longer aligned with the company's vision. Instead of clinging to a legacy business, GE decided to divest most of its financial unit to focus on its industrial core, aviation, energy, and healthcare. Here's what GE achieved through this strategic divestiture. Risk reduction. Shedding a high-risk business reduced volatility and aligned with regulatory demands. Core expansion. The funds generated from the divestiture were reinvested into its industrial businesses. Market confidence. Simplifying the company's structure reassured shareholders and boosted its stock price post-sale. The move wasn't simple, as it involved selling billions of dollars worth of assets, but GE's commitment to realigning its business direction proved invaluable. This case underscores how letting go of past successes can open doors to new growth. These case studies highlight the importance of being adaptable. Whether it's stepping away from slowing markets or managing risk, divestitures can act as a reset button, enabling companies to build a sharper, more focused future. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.